going to ask each of my panelists to introduce themselves, and we'll start with Marina.
Thank you. So good morning again. I think I met some of you this morning. I'm Marina Adams. I am a compliance officer at the Federal Reserve Bank of New York. I'll just restate that my views are my own and do not represent the bank or the Federal Reserve System. And also, I'm not on the regulatory side, so I'm not, I don't go out and examine financial institutions. I do internal compliance. We've had an internal compliance function since 2005. So it was a post 9/11 Sarbanes-Oxley best practices program. We are not a regulated entity, but we do have some legal requirements, such as sanction screening, which applies to all U.S. persons, federal credit reporting. So there are federal requirements that apply to us as a federal instrumentality. However, the bulk of our program is voluntary and one of best practices in being a good corporate citizen. And the impetus for our anti-money laundering program, which I developed, was really the subpoenas we were getting after 9/11 regarding Fedwire activity that was related to funding the terrorists' activity. And so we realized that we had a moral duty, if not a legal obligation, to have a better understanding of our international payments, and hence the genesis of our anti-money laundering efforts. So since then, I've gone on to do a whole variety of compliance programs, including risk assessment, and currently the data privacy program. So I'm happy to be here again.
Great. James?
Hey, I'm James. I basically head up financial crimes compliance program for Scotiabank. What does that mean? That means there's 14 countries around the world where I have to face off with the MAS, the HKMA, PBOC, the DFS, or the Fed. We basically cover fraud, we cover AML, sanctions, anti-bribery and corruption, and we're starting to sort of dabble a bit in cyber. We also cover all capital markets or investment banking. I cover correspondent banking, trade finance, and anything else they throw my way. That's about it.
Great.
Cool.
Paul?
My name's Paul Cottee. I'm originally Australian. Spent some time in London and Singapore, though. I started off as a trader more years ago than I care to admit, and worked on an actual futures trading floor for a while when there was a floor. Then did some more years in front office in London. Moved over to compliance for a large buy-side, real money buy-side firm, and then an investment bank, a top-tier investment bank in Singapore. Moved to London, moved to New York about 9 years ago. I've been in the vendor space for most of that time since. I work in the product area at NICE Actimize. So if you need a surveillance system, please come talk to me, or our booth outside.
Great. Thank you, Paul, and thanks to all of our panelists. So we'd like to start out asking, and James, you can probably weigh in on this first, what are the new financial crime challenges in a post-pandemic world?
First of all, post. It depends on where you are. I mean,
pandemic's officially over now.
Well, this is it. The problem is getting into places like Hong Kong or mainland China, still not happening. It's problematic with some of the travel around the world. I'm going to touch on a couple of things to start with, and then we'll sort of ask you guys to chime in, that are the unusual stuff. So one of the ones is exams. Okay, so when we go and we do our exams, normally there's a lot of face-to-face time. You can build a rapport with your exam team. You can kind of understand where they're going with things. You can discuss things in the hallway a little bit. That's not happening anymore. So that means all of our discussions are happening sort of in either our weekly touch points or in, say, a soft close situation. And a lot of work's been done on their side, making decisions on certain things or observations they've got that could have been potentially mitigated or explained, or sort of a bit of comfort could have been given in the old days. Okay, that means that you can actually spend time with them. Now, it's very formal. I find that means that we spend a lot of time going over sort of potential issues and then sort of having to schedule multiple meetings to do that. Whereas back in the day, it'd be a lot easier just to be able to sit down with folks, which I found was very useful. The other piece that's interesting is we've had a couple of instances of catfishing. What do I mean by that? So we had people that basically applied for the job remotely, and they say in our FIU, in one of our jurisdictions, it's not the U. I know you're not on the regulatory side, but just in case, where they basically are in our FIUs, they pass all the due diligence, we do all the face-to-face meeting, and then later on we found out that someone else was doing their work. Someone else was having access to that personal information. Now that's a big killer. So trying to work sort of ways around that and having potential additional controls, whether it be they have to have their camera on the whole time they're working, or sort of where possible, we're trying to get people into the office. But I'll be honest with you, it's difficult, as you all probably know, getting people to move from the pandemic lockdown approach, sort of remote working, to now actually sort of coming back into the office. We're also finding, and I'll pause in a second to let other people chime in, that we are losing a lot of good resources and talent to people like Amazon, to Google, and other places like that. Because now people realize that they can work remotely. They don't have to be living in an expensive apartment in Manhattan, and they can be going and doing sort of analytics work that I would love them to be doing on anti-financial crime, but now they're going and doing it at some of those large, sort of entities, some of which are still financial crimes, which is interesting. Facebook are building quite a big team over there at the moment. But it's having a bit of an issue for us because we don't have the pockets that they do. So competing with people like Amazon and Google is not really sort of commercially viable a lot of the time. But those are sort of the big areas. Issues with travel, issues with building relationships with external stakeholders like regulators, and then also our staff. I know I promised I'd pause, but I'm not. So the other thing, and it's not to be, shouldn't be marginalised in any way, shape, or form, is mental health. Okay, we're seeing that a lot of people, especially if they're dealing with quite nasty stuff, human trafficking cases and things like that, they're at home, they're looking through just all they can see is the screen. They may be talking to people on Zoom and things like that, but that means that they don't have a way of decompressing or a way of, especially if they live on their own, or being able to sort of exercise those demons that they've built up over the day. Okay, that's a real issue. And we've seen that there's a lot of turnover. A lot of people are now leaving the bank because they don't want to have to be at home dealing with those really nasty cases. We've come up with smart ways of being able to sort of shuffle people around, make sure that those cases are done by people that can be in the office, can have a support structure, and things like that. But I would implore on everyone, if you're in the financial crimes space and you've got people working at home, especially on pretty nasty stuff, you need to check in with them. You need to try and get them into the office more where you can, because otherwise, it can be a very sad situation.
Okay. Marina or Paul, do you want to chime in?
Sure. You mentioned your first point, James, was about examinations, and that's something we heard early on in the pandemic. I'm talking like May, June, that clearly in-person examinations had stopped. And I think I was speaking to someone in a European jurisdiction, and they were saying that it's becoming much more data-driven. Even at that point, the regulators were coming in and saying, well, we can't come and talk to you. We just need all this data. So it became a lot more empirical rather than, as you say, things by discussions. But that made me think back to, I think, about 2009, 2010, when I was working in Singapore. And where I was working, we were a hub for a number of jurisdictions, and we were having a regulator come to us. One of the other regulators was going to do an on-site, but before the on-site was only going to be a couple of days. They asked for a welter of information. 3 months out, they wanted a whole raft of data. So I guess I'm not necessarily surprised that I wasn't surprised when it happened in 2020, and I'm not surprised to hear you say that. And when you mentioned it also became a lot more, that it creates a more formal atmosphere, and that's what happened when they turned up. It was very, very formal, and it was right. We've only got 3 days here, and down to business. Bang, 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 bang. Let's go through this data, and then it almost took a year to finalise there was nothing untoward, but it was just the back and forward and back and forward. Yeah. A lot of stuff that could have been done, just on regular meetings. It just wasn't. So, but we from our point of view at NICE, we've been cloud for a while now. So for us, it was a pretty easy transformation. I joined the company in early 2020. It was 21 months before I actually went into the office. We were hearing that we're not surprised to see these fines that are coming up or the provisions that are being made for remote channels and so on, because that sort of BYOD, suddenly people are working in a control environment. If you're a trader, you're doing your trades over the phone or through the bank's on-site LAN, and that's all well and good. And as a former compliance officer, I would go and walk the floor, and people knew that I was around, and you could almost tell people would bridle when I came along. It's like, I'm going to keep an eye on that person. I think the industry lost that, and so conduct monitoring became a lot harder. As I say, if you're trading over the phone on Friday and then Monday you're told not to come into the office, and the bank hasn't managed to get you a mobile phone, the only way you can do it is on your own device, and suddenly, hang on, we're not recorded. And I know that some regulators gave some forbearance and, okay, just take manual notes and that will do. But I think that forbearance evaporated after a few months. But to me, from what I understand, the biggest challenge is that remote workforce. And you've brought up some things that I'd never heard of, such as the mental health with respect to the financial crime side. But yeah, that to me is, I think we would probably all agree that that's the biggest single, things related to remote working is probably the biggest single set of challenges now.
Okay, great.
Yeah,
Marina,
no, I would agree with a lot of what James said in particular. I think, besides the challenges with a different type of employee engagement, it's very difficult to manage risk remotely, right? And so if you're not, from a compliance officer perspective, if you're not making the on-site visits, if you're not spending the time in conversations, whether those visits are with your customers or with your vendors or with your other operations, it's very limited the type of information that you can get or have a really good understanding of what's happening on the ground, and so you're short-sighted and can miss things. Of course, and we talked about this on the earlier panel, the risk of fraud has risen tremendously, and you're an expert in this field, but it's a challenge. And the other thing is that the industry continues to develop at a very rapid pace. So driving innovation and change and transformation in this very limited, in some ways, environment is prone to additional risk factors. So it's, kudos to everyone here who's surviving that, including us. But we have a long ways to go, and I think we're probably not going to be feeling the full effects of it, of kind of the transformation issues until a few years down the road. So stay tuned.
And I would certainly be remiss if I didn't remind everybody, since most of us have been working remotely for quite some time now, there's been more and more data out there in the cloud, online. Most of the business dealings that we do have been online. And unless that data is secured properly, that's always going to increase the risk that we're all going to be facing as well. Okay.
Just on that point before we get on,
yeah.
We have got a lot more data, and a lot more data points are being recorded. And I'm hearing from some customers now that they're finding it very difficult. They know they need to find a balance, and they're finding it very difficult to determine where the balance is with respect to things like personal data and telephone recording and conversation recording and things like that, from the point of view of what needs to be recorded versus what shouldn't be recorded, and especially in the retention side, what needs to be retained and what should not be retained. And one customer that I was talking to literally last week in Germany was saying, well, the problem that we have, and BaFin, the German regulator, is very open about this. You go onto their website, and so I'm not saying anything controversial here. In Germany in particular, they admit they've got a very checkered past with recording conversations and things like that, going back to World War II and then East Germany and more recent scandal, a couple more recent scandals that they had. And as I say, this is on their website, so I'm not saying anything that's in PC or anything like that. They're finding it very difficult to figure out where that balance lies, and pause switches and all that sort of gear. So I just bring this up as a point, but that is another challenge that I think needs to be borne in mind.
Yeah, and I mean that's really the housekeeping side of the house with compliance. We've had to rewrite our fair and accurate communications policy that addresses both recordings, social media. I mean, you have all these new channels, right? And they have different recording functionality. There are privacy implications to recordings as well. And then there are staff management issues. So the our records management program has grown in collaboration with legal tremendously over the last 5 years.
And for those organizations that do business in multiple states, within the United States or outside of the United States, there are different laws that affect privacy issues, whether you're able to actually, send out this, message that you have to let them know if they're being recorded. So that's a whole other issue as well. The second question how can the US Anti-Money Laundering Act of 2020 guide financial institutions as new regulations are promulgated and phased in? And we're going to start with you on this one, Marina.
Sure. So first, that's a very ambitious question. For those of you not familiar with AMLA, which was passed in 2020 by a hugely bipartisan vote, it is very expansive legislation. You know, the most expansive legislation probably since the Patriot Act and the Bank Secrecy Act. And it covers and enhances a lot of money laundering identification and provisions and creates a lot of structures. Much of it has not yet been implemented, right? So stay tuned. Really one of the larger purposes of AMLA was to address the general fight against crime, specifically targeting corruption, specifically targeting correspondent banking relationships, and to your interest in forensics, how do you identify nested relationships within correspondent banking relationships? So obviously a huge risk, especially when you're dealing with an international payments context, is who are all the parties to the transactions, who are the ultimate beneficial owners, and who receive the payments or who are issuing the instructions. And so one of the huge innovations, I guess, that the AMLA puts forward is the Corporate Transparency Act, which requires registration by companies. And FinCEN, which is part of the Treasury, is supposed to create a database of corporate ownership so that this information should be used by law enforcement. They have not yet created it. There are a lot of challenges, including budgetary funding challenges with creating that database, but it's supposed to take a huge step and take a burden off the financial institutions from doing all that due diligence on their own, although it doesn't relieve them of those obligations, of course, because one of the things that you can do to get ready for implementation of the regulations is to have a better understanding of who your customers are doing business with, right? That's kind of a basic element of the program. There are advances, so the legislation also proposed advanced suspicious activity report sharing with affiliates. And FinCEN has a pilot program right now for that initiative. We'll see how it pans out. Again, a great boost to law enforcement if it works, but they have to address potential liability issues in terms of sharing data and how that information is used by affiliates, to make sure that there are safe harbor provisions in place that protect the institution that is sharing the information because it's customer data, right? It also sets out a set of national priorities, which is all encompassing. There are 7 primary priorities dealing with corruption, virtual currencies, and the like. And if you're looking for additional ways to assess your compliance program, you might want to take a look at the priorities to make sure that you're prioritizing your program consistently with that, although I warn you, it's very broad. It's very broad. It kind of addresses all of the potential financial crimes, transnational criminal, drug trafficking, slave trafficking, a whole host of priorities. But it lays them all out in one place, and I think that's beneficial to have. It's unclear yet, obviously I'm not speaking on behalf of my colleagues, but it's unclear yet how financial institutions will be assessed by regulators based on those priorities because they are quite expansive. Arts and antiquities are now included in the types of assets and services that could be susceptible to money laundering. And that's, I think, a very interesting thing and something that individuals, colleagues of mine in the industry have been fighting for because that's, obviously has been, the art world has not had the same reporting obligations and will now have some more reporting obligations so that people are not hiding their assets through art and antiques. And then there is a strong push for collaboration with law enforcement. Again, so the whole purpose of this legislation is to bring more transparency to enable the fight against crime, to have this partnership between financial institutions on the one hand and law enforcement and regulators on the other hand. So there's a big push for that.
Okay.
I will stop for now.
Okay.
Can I say something
James?
just quickly? So I think it's fantastic. As I mentioned earlier, there's lots of jurisdictions I touch. And in this country, there's a lot of transparency. You have the FFIC manual, kind of tells you exactly what they can do, tells the rules of the road for the examiners, what they're going to be looking at. And I think this is an additional piece of legislation that kind of actually gives you more of an insight, understanding exactly what the priorities are. I mean, that's not something that every country does, I'll be honest with you. There are a lot of countries that's kind of secret squirrels where they don't want to tell you what it is until you do it wrong, and then they come and hammer you. But I do think it's fantastic that we have that here. One thing I was going to mention, I do know it wasn't our institution, but another institution did get an observation stroke finding on the back of the fact that they didn't incorporate into their risk assessment all of the priorities,
Yes.
and not having them in there and being
I
explicitly.
have heard that as well.
Yeah.
Yeah, I have heard
So
that as
put
well.
it in your risk assessments, people. Honestly,
Yeah.
it's a
Yeah.
freebie. But no, I just wanted to say that I do think it is really lovely. And it's nice to have that transparency. It makes our job a lot easier. We're all on the same side. So, I think that's kudos to this country. And to the Fed.
We'll take all the kudos we can get. Paul, do you have anything you want to add?
Yeah, I mean, from a surveillance product vendor's point of view, we're always trying to provide our customers with useful tools. And one set of products that we're working on at the moment is breaking down the silos between AML, CTF surveillance and trade surveillance. Coming hot on the heels of the thematic review that the FCA did and FINRA's piece a couple of years ago on this, where they brought out the red flags. So one of the bigger challenges we had is clear idea of beneficial ownership. Saying, okay, if you're doing mirror trading between an entity in a restricted jurisdiction trying to move money into an unrestricted jurisdiction, such as one bank found out the hard way from the FCA, that sort of beneficial ownership transparency will be massively helpful in that regard. So that's something we're definitely looking to integrate and bring into the product.
Okay. So how is it that companies are going to be able to keep up with a rapidly changing regulatory and threat landscape? And James, we're going to start with you on this one.
Okay, so there's the obvious ones. I mean, sort of read the regs. Make sure you have a regulatory compliance matrix. What that is basically, make sure that you've got complete coverage for all of the different regulations you've got to abide by. You can incorporate the Wolfsburg pieces, industry best guidance, things like that, and then map that against your controls, because that then shows any exam team that comes in exactly why you're doing what you're doing, and you've got it all covered off. And it means that you sort of know it. But really, that just keeps you level with what the regs are at the moment. What you need to do is go a step further. Public-private partnerships are fantastic for this. Being part of sort of industry forums like Gimlet and other bits and pieces, to make sure that you can sort of understand what's coming down the pipe. And there's one thing that I started doing, and it's expensive, but it was quite a good idea at the time. It was going to places like the IMF. So I got an invitation to the IMF, so I went there because that's where they start talking. And sort of 5 or 6 years ago, I went there and they were talking about beneficial ownership registries, and everyone needs to do it, and the corruption. Then there's lots of talk about the ESG piece, about sort of if you look at the environmental stuff and really the social stuff now. And I found that was a really good way of getting ahead of the curve, because it's not just a sort of horizon scanning. I want to know what's over the horizon and down around the road and around the bend. So doing those sort of things are incredibly important, and also just ask. This year, we had an exam team from the Fed, in fact, that were very open. They were forthcoming, telling us what they've seen at other banks. Without any names, of course, but telling us about sort of some of the things that are also being discussed within the Fed or within sort of the Electoral College and other things where where their heads is at, and therefore you get an idea about the direction of travel when it comes to regulations. And also going back to the public-private piece, being able to be involved in crafting the regs is the key, because then you're basically ahead of the curve and you can start building your controls. I have seen that influence go to some extremes, like in Singapore, where ongoing negative news screening was something that the large banks could afford to do. And so they basically made sure that you should screen everything on an almost daily basis, which is crazy. And of course, the smaller banks couldn't compete with that. But the MAS felt that was the right thing to do, and so it held them to that standard and kind of pushed out some of the smaller guys. But I do think it's very important to be lock and step with both the regulatory bodies, but also understand how law is created. Okay, there's a lot of steps to go through before something becomes actual law. And also, you can also to step into those areas like the Wolfsburg. The amount of influence those guys have is incredibly important. So having a seat at those tables is probably one of the best things I can recommend to be able to be ahead of the curve.
Excellent.
I would just add that on the topic of collaboration with law enforcement, I think it's a great idea. It is free training to your people to invite somebody from the local FBI office or other law enforcement agencies. They will provide you with examples. They'll provide your staff with examples of what to do and not to do. And it's very impactful. It's usually free. And I think training and being very much in touch on those scenarios is a very helpful way of understanding the risk landscape.
And certainly because most organizations have limited resources to be able to address these problems, you want to try to collaborate with as many organizations and people as possible, because we know from past experience that the bad actors certainly have a lot more resources that they can use against us than we have in the opposite direction. So.
Especially if they happen to be, in some cases, I think, maybe I'm going a little close to the wind here, but if some of those bad actors are, shall we say, state-funded.
Right. Okay, great. So how are RegTech solutions then helping in the fight against financial crime? And we're going to start with Paul at this one.
It's interesting you say how are RegTech solutions helping in the fight against financial crime rather than just ticking the box. The question suggests a level of proactiveness. The point I'm making there is I've got a global remit, so sometimes I talk about regulations outside, or quite often I talk about regulations outside the US, so please bear with me. But for example, in the European, going back to what you were saying earlier about joining in with the rule-making process, the Lamfalussy process that went on for MiFID II and MAR in Europe would be a good example of that. The bank I was working for had lots of people going to discussions all the time to influence that. But one of the things in those regulations, the European regulations, it explicitly says firms are expected to have surveillance systems in place, and there is an expectation they should be appropriate to business, but there's an expectation they'll probably need to be automated. So working as a vendor, when that came out, I raised my hands and said, hallelujah, that's the best advertisement that I could have had. But what I'm saying is there would be, one approach would just be to say, oh, we need to have a system, RegTech solution so we can tick the box. Done. I prefer this approach where you're actually using it to detect stuff, to fight financial crime, to pick up what your traders or clients are doing. The first time that I started doing surveillance back in 2009, I started using this system, and I said, well, where's our manuals? And my boss said, well, we don't have any. This is the first that we're doing of this. Okay. So I kind of wrote the policy on the fly, and I said, is my KPI for this, should I be looking at am I trying to get people sacked? Am I is it if I can get 10 people sacked, 10 traders booted out the door for wrongdoing in the next 12 months, is that a good thing, or do we want 0? And my boss again scratched his head and said, don't know yet. It kind of comes down to where we set our thresholds. So from speaking from the vendor's point of view, how we approach this and how I as a former compliance and surveillance officer approach this is to say, okay, well, what's going on in the market? I come to things like this and try and make sure that, I'm sure all the vendors here, we constantly try and talk to our customers and talk to new customers and talk to regulators and try and make sure that our products are as good as they can be. I like to go back to the traditional methods though sometimes, and I say that there is definitely, we hear about all this AI and ML and all the rest of it. I still think there's very much a place at the heart of surveillance and RegTech for rules-based. If you look through Dodd-Frank, if you look through MAR and so on, there are typologies. You can see them pretty easily laid out. So the best way to get those done is rules-based. This is what spoofing looks like. So you design a rule that catches spoofing. I think where ML and AI come into play though is, and keep in mind if you're employing those things or a person comes and says, oh, we've got great ML, explainability is key. You can't just you can't just have a black box and press the button and walk away and go to lunch. You need to be able to explain to the regulator when they come around, well, why did this get caught, or why didn't this other one get caught? Oh, well, it's the ML, not good enough. It's the algo, not good enough. You need to understand what the algo is doing. So we're constantly looking at these sorts of things. We've got a lot of data scientists that are trying to, and computer scientists who are trying to figure this out. We're using ML as an overlay and saying, okay, well, how can we say cut down on false positives by how do you look at, or how do you dispose of certain alert output? You know, this customer constantly gets certain returns. Okay, well, we can put them aside. So how we're trying to fight financial crime is to make your lives easier at the end of the day. It's not always easy, but trying to come up with more efficient ways of doing things, not just broadening the approach, but coming up with more efficient ways of doing it, more user-friendly ways of doing it. I'm taking up a lot of time, so I should pass on here. But as I say, we're trying to build from the ground up, keep the simple things simple, and as new threats come out and get identified, follow the cases, follow the new laws, and build them in using new methods.
And I think one of the summaries that we can assert to Paul's comments is that when you do set up the technology for this, you don't simply set it up and walk away. It's cyclical. You have to then review it, make sure that it's working, see what's not working, and then go back and make tweaks to it as needed, right? Marina or James, do you have anything you want to add?
I've got a favour to ask. So one of the issues, so vendors, it's great what you mentioned about sort of transparency, understanding how the algorithms work and things like that, but we also need to be able to prove it. So we're seeing now from our audit team and also from some of our regulatory supervisory bodies that we need to do like DFS 504, so complete data lineage on payment screening and on transaction monitoring. But then we get to a tool and suddenly there's two parts we can't sort of see the data move from one place to another to show the lineage. And of course, we have the same conversations where, okay, well, if you can't share that information with us and we can't demonstrate it, then we're going to have to change vendors and that sort of thing. And it feels like we have to get to this point where we really put the screws on to be able to get any information to be able to then sort of provide, whether it be because it's proprietary information or anything else. It would make it a lot easier to be able to have a package when you buy a tool that it says, here's our audits, here's any validation we've done, here is the lineage, or here's access to it. That would be incredibly useful to financial institutions. So yeah, there you go. Another bit of free advice.
I appreciate it. Yeah, we do get often asked, okay, well, what are your model risk audits and things like that? And it's hard for us to say that because we do provide a lot of documentation when we deploy to a customer, and in terms of the data is the customer's data. So we get it in, there's an agreed, we have a format. So it should be pretty clear where when data's just on that point, where it's how it's coming in and then how it comes out in the front end. You should be able to, if a transaction's on the input data, then you should be able to see it when an alert is generated.
It's the reconciliation piece is difficult, and it's like without naming names, CGI, Trade 360 and the Bridger piece, we can't see between those two, and that's a problem. In Oracle, there are also some other challenges that are happening there, and every time I meet a vendor, for example, I always try and sort of put a bug in their ear because it makes everyone's life a lot easier. Because at the moment, otherwise, like you said, it can't be a black box. We need to, we need to prove it. So yes, we know that it goes in this end and comes out here. We can reconcile it, but then even our audit team saying, well, prove it. Like we want to be able to see the validation, like we would do with the rest of our program. So we're having challenges there, but a partnership with our vendors, much like partnership with law enforcement, is the name of the game.
See, Paul, this gives you some more feedback for more options of programs and things that you might want to suggest. Marina, do you have anything you want to add to that?
We've come a long way. When I started as a junior attorney advising my clients in our central bank operations, they would remind me that when they started, the OFAC list would sit on the radiator about yay high. And I'm like, okay, so I'm just complaining about 3 different OFAC applications for 3 different business lines, and you don't have a lot of sympathy for that, do you? So, you know, with data comes a lot of challenges. I think there are huge advances. Even in the period of time that I was managing our sanctions program, I was amazed at from the beginning to the level of sophistication that we were able to get information that, previously had not existed. The information was not in the filters, so you couldn't identify Iranian transactions if the word Tehran was not in one of your filters, or very silly things like that you don't realize until you implement the technology, kind of like the shortcomings, right? The previous panel, I think, people will say, well, if you just give us the rules, we'll put them in. What's the problem? Well, sometimes you don't know what the rules are, right? And it's not until you have a great amount of experience with these typologies and running these scenarios through your system and having good colleagues in audit who will come in and do the testing from an objective perspective that perhaps you may not have been able to do, that you start refining that process. So it's a work in progress, and it's a great deal to manage.
And many times, if you're involved in setting up that system, you're not the best person to anticipate what other questions or things might arise.
That's right.
How might risk complacency create a potential safety threat for both the organization and its customers? And we're going to start with Marina on that.
So, of course, I cannot imagine people being complacent about risk. But all kidding aside, I think, especially in the area of long-term customers, I think that sometimes relationships develop, and people don't reassess the risk posed by that particular customer. And I think it's very important to remain independent and continue to check in, and continue identifying what is that customer's line of business? What products are they now developing? How does that impact our risk rating? Are our systems being able to identify those changes? Can we calibrate those factors sufficiently so that we do have an accurate assessment of risk? So I think that's an area where we as compliance professionals, there are multiple responsibilities. Sometimes it's easier to address new risks than to reassess old ones, but sometimes that's the ones that get us in trouble.
Okay. Do either of you have anything you want to add to that? Otherwise, we do have some questions from the audience here, and I'm sure that they're waiting on tenterhooks.
I'll just say one thing. Any other Aussies or Kiwis in the room? Hand up. Right. So you'll know when I say the phrase "she'll be right." Right. So there's an Australian phrase called "she'll be right." Usually spoken, yeah, she'll be right, mate. And what that means is, don't worry about it. It's good. We've got things set up. Things are humming along nicely. So I guess complacency. I can say this because I am Australian. Sometimes Aussies are seen as a bit lazy. You just kick back. Things are good. Right, let's go to the pub. That's an extreme, but what I'm getting at here is just because you think, going back to the previous point you made, Marie-Jo, about constantly reviewing, you can't, and the FCA made this point within the last couple of years about reviews. Just because you think you've got the boxes ticked and you didn't get an audit finding in your last audit, it's not good enough. You do need to review things. You can't, if you just let it go and say, oh, she'll be right, that's complacency coming in. Now we've seen on the business side, we've seen occasionally you'll hear of some, and we're seeing a lot in crypto, a broker or a clearer or something will blow up because of burn through, because they didn't look at the risk, the financial risks enough, and one client went bad and burnt through, and suddenly you've got EDNF Man or the Man Group, there have been several big blow-ups out of a job. So I would say that it's not only on the compliance side, it's also on the financial side, but I think there are plenty of examples of complacency being a bit of a cancer and coming in and people not doing their regular reviews and just saying, oh, she'll be right, we've got it sorted. Not checking their thresholds on surveillance systems and things like that, and lo and behold, they come in one day and things blown up.
Okay. So somebody from our audience would like to know, how does the fight against financial crime differ between large traditional institutions and new neo-challenger banks? Is the latter better at adopting a digital-first approach? Anybody want to attempt that
I can have a go at
one?
that if you want. So prior to Scotia, I was at Promontory Financial Group for 10 years. Okay, so I've seen every type of bank you can imagine, and MSBs and everything in between. I think that there's a potential that they should, common sense thinks that they should be, but in reality, a lot of the time, I've seen the banks fall down because they haven't got that sort of long history of what could go wrong. So if you see what I mean, the large banks, I find it's always good when I went into a new bank, I'd find the people that have kind of been there for a period of time, have the institutional knowledge, but also have seen enough controls fail that they know what they're doing, if you see what I mean. And you can focus and use new technology and things like that, which is great, but it always still boils down to, at some point, there's a person involved. There has to be, okay, in my opinion. And there's implementation issues and operational issues. All of those, I find there's a certain amount of experience at the large banks. I would always recommend whether my clients to get a mixture of new people that are new to the industry, or new movers, as it were, and then get a couple of what I would call the more seasoned individuals, be able to come along and kind of give that sort of experience. But the one thing that they don't have is they don't have the really molasses-like infrastructure change problems that large banks get. I mean, there's so many good ideas that I've just had to shelve because it's just the cost of implementing that dwarfs the cost of the actual tool, or what I'm trying to put in, which is a real problem. It's frustrating.
Right. So what are then some of the key roadblocks then for these larger institutions to be able to implement this first approach, the digital first approach?
First of all, the data is completely broken in large banks, I'll be honest with you. They've got 50,000 different, or say in Canada, we've got 275 KYC systems. Okay. Now, all of those have got different information in them. They've got different sort of ages in there. The larger the institution, the more they may have tried to centralize things. And now you've got stuff that's come in from Mexico. You've got stuff that's coming from Canada, from the US. Now, all those things sort of mix together. And so then you go for they have to go for a big bang change. See what I mean? It's hard to incrementally sort of put stuff in. And really, the biggest problems we've got is data and old infrastructure.
Okay.
Those are the biggest challenges I've come across.
Okay.
What about
Anybody
sign
else?
off in terms of getting things signed off? It might be several layers away. I think if someone's doing a startup in their mother's garage or something, then they're the person that's signing. Well, actually, let's say signing the checks. They wouldn't have been doing that. They're the ones that are pressing the go button on their payment app. Whereas I think what we found, and coming from a bank, being an ex-banker myself, actually trying to get something signed off and approved, it's got to go through so many layers of approval, and it goes up to that person, and then that person, but they're on holiday or mat leave or something, and then it comes back, and it's got to go through 3 or 4 layers before you can actually find the person that can actually say, yeah, we're doing this, and that all takes time.
That's easy. I just sign it off.
Sorry?
I just sign it off at the bank. Basically, I ask for forgiveness rather than permission. Sometimes it works.
Anything
So
to add?
large institutions, of course, have resources, have expertise, have established operations, but if you are a small institution, don't underestimate the power of a lean compliance program. If you effectively identify your risk, you will find that you are able to focus on your particular risks, your particular customer base, and address that appropriately. So you may not need an automated system for X, Y, and Z because you have a different type of clientele. But you have to be objective about that and get good advice.
So there's certainly more flexibility than with the smaller and newer banks than there is with the more established. So I want to just thank our panel members for everything. I think this just about brings us to the end of our session. And please join me in thanking them for all the information that they've imparted.